let's take our conversation forward. Let's understand that why markets have not fallen despite what's happening on the medical front. Is this complacency, or markets are telling you that it's time to move on and time to look forward? Vinit, good morning. Thank you for joining us. I'm surprised, and I'm also delighted that markets are holding on. Are markets telling you that look forward, or this is complacency?
Yeah, Nikunj, hi, good morning. I think now we've got used to markets not behaving the way we wanted to behave. I think we saw last year, while we were in the midst of complete lockdown, we were in the midst of first wave, which was absolutely not known to anyone as to what would be the repercussion. I think the market just took a decision to sort of take its own move. Disregarding what was actually happening in the economy. And what we realized towards the end of the year was that the market was right, and most of the analysts were later on doing the catching up exercise in terms of the fundamentals. And I think rightly so, what has also happened is that the companies per se last year performed quite well. Towards the end, I think in rotation sectors started performing, and towards the end we saw the banking, and now followed by metals, which are doing well. So I think through the last year, one important observation which we have is generally the corporate balance sheets have improved quite a bit. That is one very important takeaway. Secondly, I think most of the companies are sort of aware as to what were the challenges, and in a way slightly better prepared than what they were last year. While I would agree that this time around the second wave has proven to be slightly worse than what was last year. Companies, we are interacting with companies post their second quarter results. What we gather is that the impact on the employees to the companies by and large has been 3 to 4 times more than what they saw last year. So I'm assuming that the impact of all of this will surely be felt in terms of the recovery process getting delayed. Coming to the markets, really, what does that do to the market? I would say that markets would run more on the expectations. One key risk in terms of the expectations getting not getting met is the fact that as the recovery process gets delayed and there is a heightened expectations on earnings, once we see the mismatch of that taking place probably for post the first quarter numbers, I think that would be time markets may sort of take cognizance of that and may remain sort of subdued till then. So I think that's what we can sort of capture from the trends last year and what we are seeing this year.
Vinit, while I completely buy your argument that the balance sheet or the corporate balance sheet is much better, they understand how to manage cost, the worst of the NPA cycle is behind us. But what about the retail balance sheet? There is a lockdown which surely is impacting demand. There is a lockdown which certainly will have an impact on income. So while we can say that corporates are better and they are going to do certainly much better because inflation is also there, what about retail balance sheets? The demand for apparel, the demand for clothing, other discretionary items, won't they get affected?
No, Nikunj, I think you're absolutely right. I think the impact of this pandemic is going to fall on each and every segment. It is just that it's a bit uncertain as of now, and most companies by now don't have the data points to come out with a clear picture as to how that all impacts the demand momentum. Let me tell you, we are also sort of a view that the whole demand recovery process, which had started since, let's say, September of last year, there is going to be a bit of a halt there. There is going to be a bit of a slowdown in terms of the demand momentum. And the simple reason for that is, Nikunj, like you said, I think there is an impact on, let's say in this pandemic, the upper middle income has been deeply impacted is what we understand. So that's number one. Emotionally, I think it has been quite draining as far as this second wave is concerned. Third, I think beyond everything, I think we are also seeing price increases because of the input price pressure, which is leading to, all the companies sort of taking price hikes. And this is not the end of price hikes. I would say that, for the companies to decide whether if they want to maintain the margins, then I think they will have to see further round of price hikes across the board. So I would say, given those aspects, and secondly, one round of pent-up demand we've already seen happening last year. I think surely there is going to be some slowdown. What I would say is that the recovery which we were anticipating, let's say earlier than later, now we are pushing down the whole recovery prospects to, let's say, second half of the financial year, when the whole recovery might take place. And you're right, retail that manner will be sort of a bit more delayed or lagged in terms of driving the recovery in terms of demand.
What I can see from your recent portfolio changes is that you've reduced your exposure to HUL, Chola, Britannia, Cipla. You bought into Tata Steel, SBI, Dalmia Bharat. You're leaning towards corporate banks and industrials. Why?
So I think across the portfolio, each portfolio manager sort of reflects his or her view. But broadly, by and large, what we are trying to sort of generally do or indicate is that first of all, we were very positively surprised by the whole banking sector having controlled their problem assets in this pandemic. Initially, our assessment was that the banking sector will be more impacted, but as we saw through last year, towards the end, I think they were able to manage the impact quite well. Most of the banks are now, in a way, also well positioned as far as their buffer provisions are concerned. So I would say they are well prepared today. Now, when we go through this pain process for the next 6 months, it's likely that even the banking space is going to go through that phase. But remember, the banking sector is in that low cycle today. We are still in that 5-6% of credit growth in the economy, and our base case is that as some of the the government measures which they have announced, as they start taking shape and as they start improving the demand process, the banking sector is likely to do well. Getting the validation that they have been in a position to sort of control their risk there, I think that gives us a strong case that for some of the banks we remain positive, and it's a good way to sort of gradually accumulate. The second aspect is that if we just spoke about this demand getting derailed because of various factors. Now, just to think of how the growth is sort of going to pan out in terms of the timelines, we assume that the growth is going to be backed by what the government is doing in terms of reforms, what kind of spends they are doing. And most likely the demand curve is going to be first driven by largely the B2B businesses. So be it the cement, the heavy metals or engineering companies per se. And the follow through of that would be as the activity levels in the economy starts improving, it creates more consumption demand, it creates confidence in the economy. And to that extent, the B2C sort of is more back-ended. So I would say some of the changes within a few portfolios are reflecting those. And there would be still, value hunting taking place in the structural stories, which is consumption, pharma, and IT. At some point, if they become expensive, it's good to trim in the position in the portfolios. At some point, when they become good to look at from valuation perspective, I think it makes a case to even add from the long term.
Okay. If you're looking at sort of materials and sort of that's, that segment, whether it be cement, whether it be infra, metals, commodities, some of those names starting to continue to actually build momentum, would that start to take a larger weight in your portfolio? Possibly not yet, but is that something that you look at strategically? Do you see that becoming a larger part of the pie?
So I would say that, as I said, that each fund has a different reflection of, these thought process into their portfolios. So, we have funds where already some of these segments are having a much higher weightages, and more particularly the metals as such. In my portfolios, the representation is more through the cement as a segment, because I believe that that's one segment where the impact of this will be felt much more. There is a better reflection through engineering companies. The point is that as we see more and more CAPEX taking place, some of these engineering companies which have been lagging growth and are in a low cycle of growth should start doing well. And whenever the cycle turns for these companies, we have seen the impact of operating leverage, which causes the profitability to show a marked improvement. And I think that's what sort of we are looking at.
Okay, and how much of how much of action are you anticipating in the broader markets? You've seen fantastic returns, of course, on the mid-cap fund. Given the kind of interest that seems to be building there right now, and the fact that we do have some choice picks when it comes to some of the pockets that you're bullish on in the broader markets, what would you be looking at? How much of the investment would be on mid-caps versus some of the index heavyweights right now?
I think through time I have been sort of stating that I generally hold a positive view on the broader market, on the mid caps and small caps, and I have sort of looked at these categories for long. I believe that they have the potential to create wealth over a long period of time. But today's environment is also making me a bit cautious when I look at the type of companies which are hitting circuits daily. It is sort of giving me indication that we are looking at a scenario where closer to what we had looked at towards the end of 2017, when we had seen a frenzied rally taking place in the small and mid caps, and I think towards the end we had absolute non-quality stocks also doing well. So some of those changes in the stock prices, when I see across the broader market and the type of companies doing well, it creates a bit of that concern in my mind that the retail investor is getting a bit more frenzied, and people need to sort of moderate their expectations. We already seen a very strong return in the last 1 year. Even the mid caps, some of the investable and quality mid caps, they are not trading at a level which it is considered cheap. We would sort of want to wait for reasonable price points to enter into these mid caps. So I would say that while I hold a long-term positive view, but I would want to wait for better price points to sort of make a meaningful entry into the mid caps is what I can say.
Vinit, hi, good morning. You had mentioned that among the domestic cyclicals, the auto ancillary is a sector that's poised for a strong revival once we do see the overall CAPEX cycle picking up. Do you continue to believe that there is a strong value to be made within the auto ancillary space?
Yeah, I continue the positive view, which is also reflected in the portfolio exposures. We have, skewed exposure to the auto ancillaries versus the OEs. And the simple reason there is that, the auto sector has seen, cyclical lows. And this is just not true to India, but it is true globally. And, when the sector actually dynamics improve, when these, cycle turns from low to high, these auto ang players, I would say, are also going to be beneficiary of that cycle improvement. Secondly, I think that the auto ancillary makes a good diversified case of playing the auto sector, because these companies are just not catering to the Indian markets, they are catering to the global markets, and that makes the case more, it gives more diversification to owning that business. It also means that if any one particular geography is sort of, let's say, delayed in terms of catching up, these companies will try and find out opportunities elsewhere to grow. So I would say auto angs, we continue with a positive view. We have quite an overweight position across many of our funds in that category, and I think I would continue to maintain that view.
I know you spoke of opportunities within the mid caps after some time and as things revive, but you had been fairly bullish on the overall agri theme. With the onset of monsoon now, is there anything very specifically that you would be looking at within the agri sector? How are you looking at the overall rural demand panning out as well amongst some of the other larger spaces?
Yeah, it's too early to predict the overall quality of monsoons, what we're going to have this year, while the prediction is still good. But let me tell you, in the back of strong 3 years of good monsoon and strong agri cycle, our expectation is that generally the rural health in terms of their income levels has improved quite a bit. We have seen food inflation, which is let's say benefiting the rural economy as such. And there has been a lot of support which was also extended to the rural community. Plus, the first round of pandemic really didn't have as much effect on that rural part as such. This time around, it is impacting that, and that's one cause of worry as far as the rural side is concerned. But we believe that there is a lot of opportunity to be captured in the agri market. India is a country, where we have almost about 150, 160 million hectare of irrigable land. We are just about 50% irrigated, and there's a huge amount of that irrigation potential which is there, and beyond which, even the produce needs to increase, the yields needs to go up, and the consumption of the agri inputs has to similarly go up. So we believe that while we will keep having one or two rounds of good year, bad monsoon, good monsoon, but on the whole, we have seen companies, focused on value-added products, focused on branded products, focused on growing the distribution network. I mean, those companies through time have grown, and we believe that that's a good place to be. These companies are generating positive cash, they are generating good ROC, and hence that's one space which has a huge opportunity, is what we feel.
One pocket where I genuinely get slightly worried is the auto space, and it's a double whammy for them. Lockdown is going to impact sales. Mahindra & Mahindra, I think last week said that we are bringing our outlook on tractor sales down from double digit to single digit. So lockdown impact, and on top of that there is commodity impact. Do you think autos now, even though they are considered to be a proxy on demand, will be an underperforming sector?
Yeah, Nikunj, I think which is where the thought of having auto ancillary skew was there. But even the auto ancillaries are going to be linked to the fortunes of the auto OEs. So definitely the auto OEs are going to go through a bit of a pain period for the next 6 months, is what we also believe. While we were sort of getting slightly more encouraged with the recovery, what we had seen, but sort of that has now hit a roadblock in the next 6 months or so. And you rightly mentioned, I think because the pandemic has actually now spread even in the rural areas, that may cause some of these even the tractors and the equipments which goes into the agricultural or the rural economy, those may be sort of slow for a while. But a point to remember is that anyways the auto cycle has been at their lows if we look at the last 2 years, and hence I think what one needs to sort of focus on is beyond these issues. Once you are past some of these issues, there is an expectation of a stronger recovery which is likely to take place in the auto sector, and hence how an investor would want to be light now and then in the midst of the mayhem want to increase. I mean, that depends upon each individual investor, but I think the near term is looking a bit more challenging. But just considering the cycle lows, we can't have a structural negative view on the auto sector.
Vinit, 3 months ago the narrative was that India was in a much better spot. Demand was coming back, interest rates were low, and the wholesale inflation had kicked in. Now it's the reverse. India is in a jam. Inflation and the bad part of the inflation is now evident, and also globally things are looking much better in terms of normalization of demand and retail activity. Whenever I speak to folks who have presence in US, they simply tell me one thing, that life is almost back to normal in some of the major states in US. If that is the narrative, what is the best way to invest in India? Stick to IT pharma, because that's where the recovery is going to be highest, or there are any other pockets which you've identified?
No, just that things changes unexpectedly in a matter of 1 month or so. I would say that that's how the vulnerability or volatility in the economy is going to be. till the time we are out of this uncertain environment, these type of data points will sort of keep, coming on a almost daily basis, and it will keep forcing us to change our views. So I would say, one should definitely have a balanced view, because, what one should try and realize is that what we are passing through, is it something structural or transient? If we believe that these are transient issues and, at certain point, these issues will be behind us, I think the ideal way is to, keep looking forward and try to size up the position depending upon how you want to keep the skew. But there needs to be a balance. Remember that, when we had started coming back on growth just 3 months back, it was, suggested that the growth will be pretty strong as far as India is concerned. And, most notes or strategy notes, what we had seen was projecting India to, have the highest growth. In a matter of 1 month, things change. And I would say in a matter of next 2 months, things can change again. And, there will be thoughts that India will come back on growth curve pretty quickly. So I would say that these are events which one has less control upon, and hence it is prudent to have a balance so that, one is not taking a very strong view in a volatile time and uncertain period.
Betting on any of the new age businesses? Zomato is going to go public soon. Nazara has just gone public. There are a lot of new internet companies which are going public.
Yeah, I think these are interesting times, and we are also evaluating, but just that as these new age businesses also comes with their new age valuation paradigm, so we need to sort of try to analyze and also assimilate those information and try to see how we have to think about valuation of those businesses. There is a lot of again, I can say frenzy as far as these issues are concerned. We may evaluate some of these as they come about because we feel that they have a good future potential. It is also likely that some of these issues which are coming up are also going to have some rub-off effect on already listed businesses which are sort of in maybe not exactly, but in similar type of nature of businesses or supporting these businesses. So it's a good point to look at those as well or re-look at those as well. But definitely these new age businesses warrants good evaluation, and which we are anyways doing.
Vinit, where do you see the maximum risk? We've talked about, a lot of sort of the pockets of opportunity, the broader based recovery, longer term bets, but where is the maximum risk? Would it be financials? And if so, how would you kind of shape the mix that you hold in your portfolio to accommodate the kind of risks that could come up?
I would say that risks will be the maximum risk can come from unknown factors. And today, while we may keep discussing what will be the impact of pandemic, how vaccination drive is going to sort of enable us to get us back. But I think beyond that, what we are sort of trying to focus on are the risks which can have the potential to derail the whole recovery process. I mean, we are dependent upon, let's say, the government's fiscal spend to, initiate the whole process of growth. And, any risks of, let's say, the challenges there because the fiscal position is not great, any challenges to government income, any challenges to the rising inflation leading to rising interest rate globally can cause major upheaval because, globally also the global debt is almost more than 3 times of the global GDP. I mean, these are unprecedented times and unprecedented levels of liquidity which has flown into the asset classes, and imagine a reversal, what that can cause. So I would say the risk potentially could be, the larger risk could be coming out from some of these unknown factors which one needs to be cognizant about. We have seen a massive run-up also driven a lot by the liquidity. There are talks of early tapering by the US and how that will sort of be taken into cognizance by the participant is something which needs to be kept in mind. So, and whenever those type of risks sort of manifest itself, then that can lead to across the board fall in across the board across the sectors. So I would say that beyond that, some of these risks which we are sort of today looking at the slowdown in the demand and all these, again, I would say these are transient, and one may want to right now, the better way sort of to deal with that, Nikunj was alluding to that, is to be slightly more defensive oriented in the portfolios. And as the visibility and of the improvement starts taking place, that's a time to sort of keep changing the portfolio mix. But beyond that, keep an eye on some of these global risks which also could manifest, because these are not something which are low probability event. These can be decent probability events as well.
Thanks for joining us this morning, Vinit, and taking us through in detail some of the pockets of opportunity that you're looking at in this market.